Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Today we are speaking with Peter Teneriello, known as the Limitless Partner. Long before Alexa and I realized the world needed to hear more from the LP perspective on this podcast, Peter began sharing his perspective as an LP in his writings. Peter has worked both as an institutional LP at Texas Municipal Retirement System, Texas Permanent School Fund, and a private sector LP. We'll speak today about lessons learned as a limitless partner from the two perspectives and what he's gained from participating in the Kauffman Fellows program, which I also participated as well. Go Kauffman. Peter, thanks for speaking with us today on Swimming with Allocators.
Absolutely. Yeah, thanks for having me.
All right, so first, we always like to kind of start on the origin story.
I fell into it. I still had another year of college, graduated, was still trying to figure out what I was going to do with my life. I felt like I was one of the only finance majors in our class that didn't have a job lined up after school. And I mean, to that point, I remember one of the career counselors telling me, despite my average, or despite my 3.4 GPA, I remember him telling me, like, yeah, investment banking's off the table. Like, don't even bother trying. I'm like, okay, that's cool. So anyways, again, like as I'm trying to, I'm trying to figure out what to do with my life. I know I want to enter this finance world, this investing world in some way, shape, or form. And as unbeknownst to me, over the years preceding this, the Texas Permanent School Fund, institutional endowment based here in Austin, they were building out their private markets program. And in 2012, they decided that they were going to start ramping up the size of the team as they were scaling up the program. So they decided they wanted to hire a straight out college analyst, and I just did my best to make it crazy for them not to hire me. And that's ultimately how I fell into the LP world.
You have this very unique perspective as an institutional LP. Can you share with us that story of what the strategy is there specifically to venture capital?
Yeah. Well, I'm gonna have to back up a little bit, go a bit higher than just like the venture capital lens, or the 30,000 foot view, as a lot of people like to say. So with institutional pools of capital, ultimately your scale and your governance, that's the tail wagging the dog. Like, those are ultimately going to inform how you invest, how you tackle various asset classes, how you tackle various strategies. And with pools of capital that large, like what we had at the Permanent School Fund, or what we had at the Texas Municipal Retirement System later on in my career, when you're investing 25, 30, $35 billion, that's ultimately going to inform and decide how you tackle such a niche strategy like early stage venture capital. For us, I remember at Texas Permanent, I mean, we were writing checks, let's call it in the $20 to $50 million range, and in private equity and venture strategies. At Texas Municipal, we had a higher minimum. I mean, granted, we had a smaller private equity team. When I joined there, I was the number 2 on the program, but the number 2 of 2 people. So it was we were very constrained bandwidth wise. We couldn't write checks that were, say, $5 or $10 million when we had to put out $500 million in commitments a year across privates. And so that ultimately pushed us into the strategy that we ended up carrying out and deploying with, deploying check sizes and in the 40, let's call it the 40 to $75 million range, or actually even higher in some cases, but 40 million plus range. and tackling and tackling and addressing the full venture landscape, not just playing in the early stage world where again we were close to being too big to really to really properly attack it, but again spending a lot of time in the mid to late stages of venture. So ultimately, the portfolio the portfolio we built at Texas Municipal, ended up being a multi-stage, multi-sector approach that, it did involve partnering with a fund of funds to
Hmm.
invest in the early stages, but it did also involve direct commitments to a couple early stage groups and a couple mid and late stage groups.
That bandwidth constraint is so I don't think people quite think about that when they're pitching or when they're thinking about these pools of capital. What does that mean from a time management perspective? Are you leaning on consultants? Do you limit the number of managers you're even considering?
You have to put some limits in place.
Mm.
In deploying again, like backing, like in backing into the number of commitments, the number of managers that they ultimately invest with year in and year out. Again, if you're deploying $500 million a year and you have two people, I mean, 10 investment, yeah, and making 10 new commitments each year, like that puts you at a pretty, I mean, you're like any more, like much more than that, and you're going to be feeling constrained. Um,
Hmm.
10 commitments, working on those 10 commitments, working on the diligence, the referencing, the legal closing, all that work. If we had to make more investments, if we were writing smaller checks and making more investments, then things would have broke, balls would have been
Mm.
dropped. The job would have been we would have made the job much harder for ourselves. So again, like that's why you need to again make fewer commitments and write larger checks when you're not as resourced as say some of your other smaller peers.
Peter, looking back at both the permanent school and municipal retirement system, you were early on both programs. And so, are there any kind of lessons learned for our allocators on like when you're in an environment like that, a large pool of capital, and starting something new, a new private equity, new venture program, what you should be doing?
When you're at such an early stage, and especially like Texas Municipal, when I joined, the program was just over 2 years old, but it was less than 1% of the plan. Those early days, those early days are, they're marked by just like trying to reach your target. You're trying to reach your allocation target as soon as you can, again, but without breaking the team's bandwidth and breaking the model. In hindsight, not that there is a lower bar for putting out that capital, um, but again, like when you're feeling the pressure to reach that target as soon as you can, yeah, decisions are going to be faster. And if depending on the target allocation, let's call it like you'll end up making, saying yes to what really are more maybes. The Whereas again, like if your program is in a steady state, you're at your target. You can afford to prune much more. You can afford to say, hey, like, we're only going to add one relationship a year. We're okay adding no new relationships. There's just, again, like there's less pressure at that steady state point. But again, in the early days, I remember feeling that the pressure to put out capital, and if I could tell myself something several years later, it's that yeah, just don't let that pressure get to you. Keep the bar
Mm.
as high as possible. You don't have to. you don't have to put out capital if you don't find people that like meet this exceptionally high bar.
So going to that high bar, and how you develop that criteria, uh, what do you think, outside of the fund size, obviously, what do you think are the most important things that fund managers should present when they're looking at these larger pools of capital?
Before even reaching that point, managers should really think hard and hard and long about whether or not to even you know whether or not to even raise money from those institutional pools of capital.
Mm-hmm.
Not that fundraising from family offices or individuals is going to be easier. But again, when you enter the institutional game, it puts you on a different track. It puts you on a track that, it's going. The fundraising will still be a slog, but there's just like different expectations and different requirements around how you invest, how you behave, that raising institutional money entails. It will. It'll likely push you into a size bracket that, when you look back several funds later, you'll. I guess it'll be tough to even imagine, like like being starting off of fund one at $10 million, and now like fund three or four, and you're now managing a $200 million fund.
Yeah.
It ends up, you end up just getting pushed into a different game than where you started, and you have to be able to evolve your approach to investing, your approach to firm building over time.
Yeah, it makes me think of friends saying, like, making that transition from an investor to a fund manager. And when you become institutional and have institutional LPs, there's definitely a leveling up where you have to you have to create an actual franchise that's going to continue to go on, instead of just some entity that might be gone in 2 or 3 funds.
Yeah.
When I think part of that, in that last response of yours, it also kind of dealt with what is actually the governance structure that I think a lot of fund managers might not understand, or smaller allocators might not understand when you're at a TMRS. Like, can you talk to us about that governance and structure on investing?
Yeah. Governance in the institutional world, the governance ends up being much more important than the investing itself. It's what will unlock the ability to invest in the most interesting opportunities. Across the well, I'm, it's not nearly as exciting a topic as I guess what types of companies are interesting, where the markets are going. But it's why at LP conferences you see so many panels that are related to how they're related to governance. They're related to how to set up your organization and design in a way that is going to lead to the best investment outcomes. With at TMRS, we reported to a board of trustees midway through my time. Well, the first couple of years of my time there, we didn't have discretion. Any fund commitment, any new fund commitment we were making needed to go before the board.
Mm-hmm.
For the ultimate approval. We would hold our IC meetings before then as well. Like opportunities were very well vetted up until that point, but you still had a process where, you just had a longer process. But by having to wait for board meetings to take these recommendations to. Halfway through my time, and fortuitously just before COVID, February 2020, we had a significant governance change there. The board delegated investment decision making authority up into a certain percent of the fund, down to the investment team level. So So once we had that, we were able, and it also coincided um, with the private equity target being moved up from 5 to 10%. So, I mean,
Mm.
to what I mentioned earlier about deploying $500 million a year, that then became a billion plus.
Yeah.
With that change made, and then with having having more discretion around the decisions we could make, we were able to move a lot faster. And of course, like with COVID hitting less than a month later, we were able to capitalize on a number of opportunities that, some of which were in process, but others that would have been much more difficult journeys, much more, much more difficult to get done had we not had the discretion in those first few months of the COVID times.
Are there specific challenges you see institutional LPs facing in today's market, knowing this sort of like unique LP asset, this unique LP class?
If an LP doesn't have their governance right, then again, like they're just not going to. If they don't have discretion, then they're not going to be able to move fast enough
Mm-hmm.
to find those most interesting opportunities. The other, I mean, I mean, one of the other challenges I saw everyone in the industry facing was falling into the trap of having to fill buckets. That is,
Mm.
at the top level, at the top level of these LPs, where asset allocation is decided. I mean, you'll have, and yeah, this is really oversimplifying it, but you'll have your public equity bucket, you'll have your fixed income bucket, your private equity bucket, real estate bucket. You have all these different buckets that once the bucket is created, it's just like this natural. I mean, this. I mean, there's it's this natural gamification that takes place. Now you want to fill that. Now you have to fill that. You have to staff up a team to, again, like, make these investments that, or to fill this bucket that, again, was decided at a very high level, and as time progresses, may just become a less attractive area to invest. Um, Look, like it was. I mentioned the private equity allocation doubling from 5 to 10%,
Yeah.
and again, like, having this pressure to deploy larger amounts to fill that bucket, to hit that target. Um, I, I believe we did it well, but look, a much cleaner, a much better solution, and one that is just one that's extremely difficult to implement, but the right, to me, the right thing to do is to have all capital compete with each other, have no asset class targets,
Mm.
to take a more, I mean, the, to take what's been called a total portfolio approach, to how the whole portfolio is run. Again, like, just finding really interesting opportunities on a risk adjusted basis. Figuring out a way to find those, like, those low loss ratio, high return, or those asymmetric strategies, and not having to worry about, oh, like, what bucket is this going to be, because even again, like, um, again, like, even at Texas Muni, where I think we did a good job of um, of combating that. I mean, there are definitely funds that would appear, that we recognize, okay, like, this is really interesting, but how is this going to fit in this bucket with this benchmark? Um,
Mm.
and I know that there were a lot of other LPs that faced that issue, to a much larger degree.
Yeah. This idea of a balanced portfolio that's set, that you have a major time delay from when it's been set
Yeah.
by the board versus what you're envisioning, where sort of everything's flexible. Is there a bucket right now you're most excited about, that if you were able to sort of up the percentage of asset allocation, you'd be sort of looking over there or looking over here?
I really hate, like, top down prognosticating. I don't want to dodge your question though, completely, but just be clear again, like top down macro forecasts, not my thing. Much more bottom up investor. I'll say that any strategies that are less reliant on leverage to get done, and in areas where fundraising has been has really been hit hard these past several years. So I mean, let's call it like, let's call it like lower mid market buyouts and growth equity within the private within the private world, and also those areas are ones that are capital starved and not reliant on financial leverage to get deals done. Which again, in the buyout world, a lot of funds need, they need leverage to get their deals done. Interest rates are super high, and so the model is just that model is really challenged now. So, anyways, yeah, like that would be my answer to that. I also there's been a lot of interest in private credit over the past couple of years. Again, like as interest rates have risen, as yields have again like exploded to levels not seen in what feels like an eternity. Private credit has become something of, well, it's become to me, it's become a consensus play. It's become an obvious play, and capital flows have been reflecting that. I guess we'll see what that means for returns. But again, like if you're going to make, if you're going to make, not like above average, or if you're going to beat your benchmark, it's going to require non-consensus decisions in investing, and again, flowing into the areas where all your peers are also playing. Like that's not non-consensus by definition.
I think that's such a healthy reminder for the managers who are listening to this in fundraising mode, because ventures sort of what they're looking at 100% of the time. And to remember that the people you're having conversations with, whether they're high net worth individuals or, RIAs, et cetera, they look at the world very differently than you do. That this is one place that they could park some cash. You two are both Kauffman Fellows, and we haven't had a chance to talk. Ernest, you've never had a chance to talk on this podcast about what that program's like. It's great that you're both here. What's the Kauffman Fellows program, and what should we know about it?
So, either me or Ernest could answer that question, I guess. But no, the Kauffman Fellows, it's a 2-year program meant to gather mostly venture GPs, but also some venture LPs, and just bring them all together to better understand how everyone carries out their craft, how people build their firms, how people invest, and ultimately, ultimately help push the future forward together when it comes to venture and innovation.
Yeah, it's amazing. I think of it as like if B School was a place where everybody was looking to go into the same industry.
Yeah.
And so having that collaboration of sharing what's going on within your perspective or kind of like your firm, and then also seeing the macro, and then also seeing the micro within the macro of other people's experiences is really helpful. Now we're going to take a quick break to speak with our sponsor.
Next up, we have our industry expert and sponsor, Dave Thornton, co-founder, CEO, and chief investment officer of Vested. Vested provides funding to exercise your stock options. Thank you so much, Dave, for joining us. So at this point, who uses Vested and why?
The employees of venture-backed companies are the ones that are using Vested typically when they leave for any reason and run into this problem where they need funding. But just to kind of provide a little bit of color into what those reasons could be. So boomerang into business school is a common reason. Getting poached by Google or Facebook or Apple or whatever is a common reason. going to another startup for a higher title is a common reason. In the last couple of years, but less so in the last 5 or 6 months, getting laid off was a common reason. And we saw a pretty significant uptick in deal volume because of that. I don't know if you remember this, but when the private markets started to crash in like May of 2022, Sequoia wrote this "Winter is Coming" memo.
Yeah.
And
cut heads now. Don't wait.
Yeah. All of the founders, even of companies that were doing just great, did like belt tightening layoffs. And so there was a pretty significant uptick in deal volume for a while. But those are the reasons that the employees will come to us. And then on the investor side, the folks that are most interested in the product that we build are the folks that have been looking for programmatic access to the venture asset class and haven't been able to get there for whatever reason. So this breaks down kind of into 2 large categories. One large category is the wealth management channel, where at the end of the channel, you've got a bunch of high net worths that maybe can't write the $10 million ticket that you need to get into Andreessen. Alternatively, maybe they even could, but they're nervous about the high octane, about the variance in returns associated with the venture asset class. And so we're kind of like a calm, comfortable way to get into the asset class for the first time, where we don't have a huge minimum ticket requirement. In fact, we have a very low minimum ticket requirement. And we've got a nice diversified pool of equity so that you don't feel like you're taking a 0 to 1 type shot on your first manager. The other larger category that we're starting to develop now and has started to come inbound to us in the last year is larger pools of capital, so larger LPs that have wanted to put a significant amount of capital to work in venture, but don't have the infrastructure in place to do so. So in order to do that, you've got to have a team that's ready to source and evaluate potentially thousands of venture managers in a given year. And like, you can find the managers you like, but they may not have a vintage that's open programmatically every year for you. So it's not that easy a thing to do. And we provide, in this very, very large unserved market, the opportunity to deploy 9 and 10 figures of capital on a yearly basis into venture in an almost index-like way, like a high quality index-like way. So
yeah. And how does that work on a, I guess when you're buying in, what does the index look like? Because this is obviously sort of rolling. You're accepting stock options from people on a daily basis.
Yeah, it's an interesting question. We're actually just about to upgrade our business model pretty significantly, which I like a lot. But historically, what we've done is we've raised committed funds, called all the capital, and then deployed it into the option exercise need that we find on the employee side. And as a result, we kind of get what we get. And we're selective and we're paying attention to companies, but a given set of companies may have no employees leave in a given 6 month deployment period. And so we can't guarantee representation. The pools still end up looking very unconcentrated and diversified from a stage and a sector perspective, but it's a little bit spiky. One of the things that we're contemplating going forward, and we're hoping that a handful of the deals that we're working on right now work out to facilitate this, is taking out, think of metaphorically as a warehouse, and doing all the employee deals into one place, kind of a staging ground, if you will. And when we've done enough and we built up enough inventory, we will look into the inventory and we will curate a nice, pristine portfolio that we can then drop into a fund. And this is something where you don't have to take, as an LP, any manager risk whatsoever. You can kind of look at it ahead of time, kick the tires, decide whether you like the way that the portfolio is constructed or not, and then just press the buy button. Cool. So I'm hoping that we can start doing that as our next set of funds imminently.
Interesting. So you'll know everything that you're buying as opposed to a blind pool of whatever pops in.
Yeah, and you can even conceivably say what you want. Like, I would love a Series A index-like fund or a style exposure.
Yep.
Or robotics, or a best of venture capital. Like, get me into Sequoia and Andreessen is a request that you could make.
Yeah. Yeah. Is there a minimum to participate?
So up until now, there hasn't been a hard minimum, although our average ticket size has been in the 100 to 250,000. Like, sorry, not the average ticket size, but the mass of tickets have been in the 100 to 250,000 range. That's probably going to continue for the next set of funds. As we move forward, call it a year or 2 years out from now, I'm expecting third-party evaluated pricing to develop pretty well in this market, which I don't know if that's a widely held belief, but I'm talking to the people that are doing it right now. And I do expect that we'll be able to start putting together registered interval funds where like we could provide line level pricing and that passes audit and is produced by an independent third-party evaluated pricing service. And if we can do that, then the minimum ticket size will go away.
Thank you so much, Dave. To start working with Vested, you can please email investors@vested.co and mention this podcast. And now back to our LP interview. What are those ingredients for a successful partnership from LP to VC? Curious how people have built relationships with you over time.
Alignment is the most important, the most important ingredients. I mean, I was thinking about that. I was thinking about this for a while beforehand, and everything ultimately comes back to that. Alignment also, it's not just this legal and economic construct. It's this attitude. It's being either being the LP, being either the LP or the GP, and fully understanding how the other is going to act throughout the course of the fund. Where expectations get misaligned is where, that's when bad things happen. That's when, that's when firms ultimately shut down, when LPs, when an existing LP base decides that they don't believe this GP will be able to, we'll be able to evolve and make money in the upcoming cycles, or if they just, or even if an LP doesn't understand how that GP has made money in their most recent fund, or in their more recent funds. Again, like if they're not aligned on those expectations, then the whole thing just kind of falls apart.
Do you think that alignment requires you to be on the LPAC, or at least have someone that's similar to you on the LPAC?
No. LPACs, in my experience, LPACs, they don't provide the protections that you think they would, or like there's not extra benefits conferred to the LPs that sit on the LPAC. Maybe you find out news before other LPs, but it's a lot. I mean, it ends up being much more work for a minimal, for a minimal return.
How do you see the role of limited partners evolving in the future of venture capital? We're seeing a lot change. We're seeing some consolidation. We're seeing the bifurcation of kind of like cottage industry versus asset allocators. How do LPs have a role in that?
I'm not sure if I see that role changing all that often. In the private equity and in broader private markets world, or private market worlds, you have seen some gigantic changes over the past 15 years. That is, you have seen more LPs, more institutions trying to emulate their Canadian peers, bringing co-investing and direct investments in-house, doing their best to combat just the expensive nature of management fees. And so far, yes, again, so far institutions have been doing well there. I don't see institutions making those changes in the VC world. There are a couple exceptions of, even a couple institutions that basically built out their own direct venture arms. But again, I just don't see those groups competing with like the established gentry of the venture world. I don't see them competing really. I don't see them competing with the the best venture investors for the most interesting companies. So again, like I think that venture LPs are like they are going to stay more passive. They are going to continue backing funds and fund of funds even to a lesser degree. And they're going to continue disintermediate, or they're going to do their best to disintermediate, but they there's only so far they can go. There's only so far that they're willing to go.
Is there one venture capital investment you're most proud of, and what made you so proud of it? And this is a time for you to kind of pat yourself on the back if you want.
During that first year with Texas Municipal, I mean, we were exploring ways to grow and build our venture capital portfolio. I mean, again, like we had all these challenges, due to our scale that I talked about earlier, and so yeah, over that time, realized, okay, like we can't be like getting a $5 million allocation to XYZ seed fund. Like that's not going to be that's not going to be interesting to anyone. That's going to get shot down well before an IC. So knew we couldn't do that. We did have an existing relationship with Foundry Group, with again like this hybrid direct / fund of funds, and just through discussions with their team, we end up creating this. Over time and over the course of the next several years, we created several vehicles with them that would allow us that would give us access to the interesting funds that were in their network, the interesting funds that they themselves were backing, but to be doing so like on a more customized, on a more fee advantage basis that that would help us solve for, again, our scale and our governance challenges. I was really lucky to work with work with the team that gave me the trust to help make this happen, pull this together, and likewise, I mean, there was a lot of complex legal work in creating some of these structures.
Oh, no, it's a very cool opportunity to be building something from scratch like that. Any final thoughts for this audience of LPs and VCs?
Touching on what I mentioned earlier, Chris Duvos, I mean, he's talked a lot publicly. He's mentioned to me before about investing with courage, and going a step further, I mean, I say again, like let's treat this work like art. Let's invest with creativity and conviction. Let's partner with people that invest with creativity and conviction. And even though it may feel like it involves career risk, I mean, yes, it does. I'd also say, like, what's the point of all this if we're not going to take interesting risks that move the future forward.
Peter, thanks so much for sharing your insights, being candid, being vulnerable. I wouldn't expect anything else from a Kauffman Fellow, but thanks, man, for being on Swim Minute with the Allocators.
Yeah, Ernest, Alexa, appreciate it. This was great.
See you later, allocator.
After Portfolio Tile, investing with a smile.